Hi everyone, Alex from Summerhill. In today's video, we're just going to touch on the recent events unfolding in Israel-Palestine and what it could mean for markets, and also the role gold plays in it as an investment, and our views of the inclusion of gold in client portfolios. Now, events like the Israel-Palestine and Russia-Ukraine conflicts obviously shock the world and can influence markets and trigger volatility in the short term. For example, commodity prices, especially gold and oil, typically jump, as do safe haven currencies like the US dollar and bond prices, and share markets can experience some short-term pullbacks. However, history tells us that geopolitical risks are always present, mostly factored in by markets, and has had little impact on markets in the long term. The reality is that there is little correlation between major geopolitical events and market upheavals. And largely, we do not view that such conflicts warrant a change to one's investment strategy. Now, when the surprise attack in Israel occurred in early October, gold prices started to appreciate. So we wanted to discuss in today's video the role gold can play in a portfolio, some pros and cons associated with investing in gold, and our view on gold as an investment. Gold has historically played a role in investment portfolios, often as a means of maintaining purchasing power in times of inflation, or as a way to reduce volatility in a portfolio during periods of market uncertainty. Precious metals such as gold have been used kind of as an insurance during periods of share market downturns. And when looking at the 6 largest market pullbacks since the 1970s, gold has maintained a positive or only a mild negative value. And this has contributed to its reputation as being a safe haven in periods of uncertainty. The purchasing power of the US dollar has continued to weaken as a result of inflation since the early 1900s, in comparison to gold, which has increased during the same period. However, it's worth remembering that the gold price is dependent on many factors, and there is no guarantee that it will continue to behave in the same manner as it has in the past. Demand plays an important role in the price of any asset. And there are various uses for gold which impact its demand and price, which, according to the World Gold Council, include just under half of the demand for gold will come from producers of jewellery and other valuable objects for which gold is used. Just under a quarter of the demand comes from central banks around the world to help manage macroeconomic risks. Just under a quarter comes from investment funds. And the small remaining portion of the demand comes from technical industry, in which gold is used in the production process. The main methods of investing in gold include investing in physical gold bars or coins, which requires both space and security, which can be complex and costly. Another means is via what's called exchange-traded commodities. Now, these are traded securities that invest in physical gold and are easier and a lower cost option than holding the gold physically oneself. And there are gold ETFs, so gold exchange traded funds. These again are traded securities, and they invest in companies involved in the mining or processing of gold. Now, some of the perceived benefits of investing in gold, which we've touched on, include a hedge against inflation, especially against cash. But again, gold is subject to price movement. Gold is considered by many to be a safe haven during periods of volatility. Gold prices often, but not always, move upwards when investors and consumers are pessimistic about the economic outlook. And diversification. Gold has been used to manage fluctuations in portfolio values, given the low correlation it has with other assets like shares and bond investments. Some of the cons, on the other hand, of investing in gold include, although gold may outperform other assets during specific periods of time, it does not hold up well to long-term price appreciation. while gold may serve as a hedge against inflation, it lacks the long-term growth potential of other assets like shares and property. And unlike shares, property and bond, gold does not generate income. It is purely based on price speculation as to whether the price will go up or down. Gold is usually associated with buying based on fear, and this is not necessarily what is best for an investor's long-term success. Gold can be volatile in the short term and go through periods of high short-term price swings. In times of economic uncertainty, the price of gold may rise, but it can also experience sharp declines during periods of economic stability. Gold brings another level of complexity in terms of investing, such as how to invest, when to invest, how long to hold, and the associated risks. And gold doesn't have an intrinsic value in the same way that a company does. Stocks represent ownership in a company, bonds represent a stream of future cash flows. Gold lacks these fundamental valuation metrics, making it more challenging to determine its true worth. So, what's our view on gold as an investment? Now, we do not include a specific allocation to gold in our portfolios. We consider gold to be purely a speculative investment, as you are essentially making a call on the price movement. Either the price is going up or down, and there's no income being generated. So it's not for every investor. However, we do understand that some investors may be interested in holding gold in their portfolios, but we suggest no more than 5 to 7% of the portfolio to consist of gold to ensure that it's being considered in the context of the overall portfolio and one's long-term goals, and not based on fear. It's important to remember there is an opportunity cost. For every dollar invested in gold is a dollar not invested in a potentially higher yielding, higher growth asset, impacting your overall portfolio returns over the long term. So that's it from us for today. If there are any topics you would like covered in future videos, please don't hesitate to reach out and let us know. Thanks.